Hello students, my name is Krunal Patel and welcome to Sijendra's Rank Zone classes. I am your mentor with respect to subject Principle and Practice of Accounting, that is paper 1 of CA Foundation course. We have started chapter 1, Theoritical Framework, under which today we are discussing one small and important topic called contingent asset and contingent liability. Now, what is meaning by contingent asset? First of all, we take definition or meaning of contingent asset. It is a probable asset. It is a possible asset. It is a possible asset that arises from past event, existence of which will be confirmed only by occurrence and non-occurrence of one or more uncertain future events not wholly within the control of the enterprise. Put attention, friends. Here, contingent asset is a first of all possible asset. What is possible asset? Which arises from past events. An existence of possible asset will be confirmed only by occurrence or non-occurrence of one or more uncertain future events which are not within the control of the enterprise. So friends, contingent asset is a possible asset. Possible asset arises from past event. Possible asset existence will be confirmed by occurrence and non-occurrence of one or more future uncertain event which are not wholly within the control of the enterprises. Treatment. What is the treatment of contingent asset in the financial statement? Enterprise should not recognize a contingent asset due to conservatism convention because this may result in recognition of income that may be or may not realize in the future. So, contingent asset should not recognize in the financial statement due to conservatism approach. Next, impact of contingent asset. Contingent asset will not affect profit of the enterprise as it is not accounted in the books of account. So there is no impact at all. Next, certainty. If the realization of income is certain, then it is not a contingent asset and same shall be recognized in the financial statement, because to be a contingent asset there should be a uncertain event. So if realization of income is certain, then it is not a question of contingent asset and so it is a considered in the financial statement, recognized in the financial statement. Disclosure. Contingent assets should not be disclosed in the financial statement but may be disclosed in the report of approving authority. Like in case of private limited or public limited company, approving authority, that is directors, board of directors and shareholders. So company may report contingent asset in the director's report. Some examples of contingent asset are as follow. Unplanned or unexpected event, unplanned or unexpected event leading to possibility of inflow of economic benefit. Next, expected gain from a legal suit. Insurance claim for damage of the property. Here, there are inflow or income arises from the events, but in the current year balance sheet, there is no recognition of the income is being done on the basis of the conservatism approach. Next. So friends, what is contingent asset? Contingent asset is a possible asset which is arise from the past events. Or existence of possible asset will be confirmed only by occurrence or non-occurrence of one or more uncertain future event which are not wholly in the control of the enterprises. It should not recognize because of the conservatism approach. It will not affect the profitability of the enterprises as it is not accounted in the books of account. If the income is certain, then there is no contingent asset, and so it shall be considered recognized in the financial statement. Now, what is contingent liability? What is contingent liabilities? It can be defined as possible obligation and present obligation. Possible obligation that arises from past events and existence of which will be confirmed only by occurrence or non-occurrence of one or more uncertain future event which is not wholly within the control of the enterprise. Likewise, contingent asset, contingent liability is also defined as possible obligation that arises under contingent asset is a possible asset, and whereas in case of contingent liability it is a possible obligation that arises from past event, and the existence of possible obligation will be confirmed only by the occurrence or non-occurrence of the one or more future uncertain events which are not wholly within the control of the enterprises. Contingent liability considered as a possible obligation as well as present obligation. In case of present obligation, that arises from past event but it is not recognized because it is not probable that an outflow of the resources is not probable that an outflow, here it is outflow of resources, embodying the economic benefit will be required to settle the obligation, or a reliable estimate of the amount of the obligation cannot be made. Present obligation which are arise from the past event but not recognized because of reliable estimate of the obligation cannot be made, or it cannot be probable that outflow of resources embodying economic benefit will be required to settle the obligation. Next, no recognize. Enterprise should not recognize the contingent liability. Likewise, the contingent asset. Disclosure. A contingent liability should be disclosed as a footnote of the balance sheet, that is financial statement itself. Contingent asset should not part of the financial statement, whereas contingent liability should be disclosed in the financial statement as a footnote. Periodical review. Contingent liability should be periodically reviewed. On such review, if the character of contingent liability found to be changed, there is a probable outflow of resources, then it recognized as a provision and treated accordingly in the financial statement. So periodically review of contingent liability required to be made, and on such review, if the character of the contingent liability is found to be changed, and there is a probable outflow resources, then it will be recognized as the provision and treated accordingly in the financial statement. Impact. Contingent liability will not affect the profit of the concern and it is not accounted in the books of account, but it is a disclose only in the footnote of the financial statement. Next, some examples of the contingent liability. Outcomes of the lawsuits: guarantee given if the principal debtor is insolvent, uncalled liability on partly paid up share. Now, last topic of the unit is provision. What is meant by provision? Provision is a present obligation as a result of past event which lead to probable outflow of resources, embodying economic benefit and reliable estimate of the amount of the obligation can be made. Features of the provision. Provision is a present liability of certain and uncertain amount. It can be reasonably measured using a substantial degree of estimation. Provision should be recognized in the books of account and also disclosed. Provision should recognize in the books of account and then also disclose. Here, due to provision, profit of the organization is, here it is a repeated line, friends. So impact of the profit of the enterprise is being decreased due to provision. Nature of account. Provision is made for liability, hence it is the nature of the representative personal account which is indirectly represent a person or creditor. Provision is made for the liability, so profit of the organization is decreases. Next, journal entry required to be passed for the creation of provision is as follows. Profit and loss account is debited to provision for liability account is credited. Reasoning. Debit aspect. Provision is an expense loss which reduces the profit of an enterprise. Hence, profit and loss account is debited. Debit all the expense and losses. Credit aspect. Provision is a liability payable in future. Hence, it is a credited. Credit the giver the benefit. Here, debit aspect and credit aspect. Consider we have debit all the expense and losses. So provision is an expense or loss. So it requires to be debited to profit and loss account, and credit aspect is a credit the giver account. So provision is a liability payable in future. So it is a credited to the provision account. Next, disclosure of the provision. For every provision, following disclosure should be required. Opening and closing balance of the provision, addition during the year in the balance of the provision, amount used or utilized out of the provision made, or unused amount reversed during the period. Reverse means transfer to profit and loss account back. Example of provision are as follow: provision for warranties, provision for discount on debtors, provision for bad and doubtful debts. So friends, here we discuss three important aspects. First of all, mark this topic as an important one for exam point of view. Now, what is contingent asset, friends? Contingent asset is a possible asset that arises from past event. An existence of possible asset which will be confirmed only by occurrence or non-occurrence of one or more future uncertain events which are not fully within the control of the enterprises. It should not recognize due to the concept of conservatism. It will not affect the profit of the organization, and this is not a recorded as it is not recorded in the books of account. It should not disclose in the financial statement. Then we take some example of contingent asset. Then we move towards contingent liability, which is defined as possible obligation and present obligation. Possible obligation which arises from past event, and existence of possible obligation will be confirmed only by occurrence or non-occurrence of one or more uncertain future event which are not fully within the control of the enterprise. Whereas present obligation that arises from the past event but it is not recognized because a reliable estimate cannot be made, and it is not probable that an outflow of the resources embedding economic benefit will be required to settle the obligation. Contingent liability should not recognize. It is disclosed as a footnote to the balance sheet. Periodical review required. If on such review, if a character of contingent liability is found to be changed and there is a probable outflow resources, then it is recognized as a provision and treated accordingly in the financial statement. It will not affect the profit because it is not recorded in the books of account. Then we take some example of contingent liability, and last we discuss provision. Provision is a present obligation as a result of past event and which lead to probable outflow of resources embedding economic benefit, and reliable estimate of the amount of the obligation can be made. Features of provision is it is a present liability of certain or uncertain amount. It can be is reasonably measured. Provision should be recognized in the books of account. Impact on profit means it decreases the profit of the organization. Then we consider the debit and credit aspect, a general entry. Lastly, then we see the disclosure part of the provision and examples. Now, at the last, we discuss multiple choice question given by the ICI in the study material. Contingent asset usually arises from unplanned or unexpected event that give rise to possibility of inflow of economic benefit, possibility of outflow of economic benefit, or either A or B. Friends, contingent asset means it is an aspect related to income. So there is a possibility of the inflow of the economic benefit. So correct answer is answer A. Next, if inflow of economic benefit is probable, then a contingent asset is disclosed in the financial statement, in the report of approving authority, financial statement, report of the approving authority, board of directors in case of company, and the corresponding approving authority in case of other enterprises are in the cash flow statement. The inflow of economic benefit is probable then a contingent asset is disclosed in the report of approving authority. So correct answer is answer B, because contingent asset cannot be disclosed, should not be disclosed in the financial statement. Next, in case of dash, either outflow of resources to settle the obligation is not probable, nor or the amount expected to be paid or settled a liability cannot be measured with sufficient reliability. In the case of with a liability or provision or contingent liability. The case of contingent liability. So in case of the contingent liability, either outflow of resources to settle the obligation is not probable, or the amount expected to be paid to settle the liability cannot be measured with sufficient reliability. Then present liability of uncertain amount which can be measured reliable by use of substantial degree of estimation is termed as, friends, it is a definition of provision. And last question is, in the financial statement, contingent liability is recognized, not recognized, or adjusted. So correct answer is contingent liability is not recognized in the financial statement. Only disclosure as a footnote is required to be made for contingent liability. So friends, herewith we conclude all the aspect and all the units of chapter 1. So in next lecture we have started chapter 2, which is the most important chapter of the syllabus. Thank you, friends.